Okay, guys, so today we're gonna talk about a couple trades and a couple things that I have seen are important to reiterate. Risk management, trade management, how we look at our strategies and really understanding it, and really what the things are that we need to look at in order to achieve the consistency that we want to achieve, right? So we're aiming for 10% a day. We want to hit 10% a day. How do we do that? Well, we need to make sure that we need to be aware of the things that can happen and prevent them as often as possible. So we'll go through that. We'll go through the indicators, all of that, and how to trade them. I think, especially you, Hubert, I think you will like this one. And yeah, so first of all, what's important is that, and this is, I've been on a couple calls today, and this is something that is important to reiterate, which is that all the work, all the theory, all the understanding of the market that we did, in calls earlier, those are very, very important because those are the underlying basics that we work with, right? You can have a great strategy. You can understand, everything. You can have a strategy that works really well. You can have a plan that's really well played out. But if you don't understand the core market principles, and you don't understand how the market moves, and you don't understand how you should manage your trade and your risk, then you will not succeed. So it's very, very important. People think that, if I have the strategy, if I have a really good strategy, that's it. Well, yeah, but that's a thing. Like, for example, when you have a race, like a car race, right? And someone would say, well, this person has the best car, so they're going to win. Yeah, but they might be the worst driver, right? So they're not going to win. So the strategy that we have is the car, but the management of it, unless it's fully automated, the management of it is still a skill, a skill or a knowledge that needs to be taken into account, right? So what do we trade? Well, we know that really this Discord is trading the stochastic strategy at the end of the day. And what that is a trend reversal, right? We're trying to catch the tops and bottoms of moves and have those, we'll trade those and, do that based on the fact or based on a theory that a market is ranging or going from a range to another range. And as it is ranging, when we get to the top or bottom of a range, then the likelihood of that bouncing is higher than going through, just by default, right? Now we add in our stochastics, we add in our bias, and then based on that, we'll make sure that that we have an edge in that decision making. So that's one thing. Those are the entries, but then how you manage that trade is also very, very important. Right. So, for example, we have our trade here, and because a lot of new people came in, what is important is the fact that how we set up our trades, right? So one thing is getting a signal. The other thing is, where do I put my stop loss? Where do I put my take profits? My stop loss is an invalidation of the strategy. How do I figure out where the invalidation of the strategy is? Well, first of all, you need to understand what your strategy is, right? This is a trend reversal strategy, meaning that at the bottom of the range, we expect the price to bounce and reverse. When is it invalidated? Well, if it doesn't do that, right? If the price breaks down lower and goes further down, well, then that just means that it didn't work, right? And our strategy is invalidated. So when the price gets to a point where we say, okay, that's a clear breakout of the range plus some cushion, that's where we put our stop loss, right? This is because that's the strategy we trade. We covered the dashboards and the strategies there. And obviously, those are different. Those are longer term strategies that, tolerate a drawdown before they have bigger moves because it's a generalized strategy. Whereas here, we want to make sure that we have a small stop loss compared to a larger take profit. So our risk to reward is, as large as possible, which, that together with the fact that our hit rate is very high, results in consistent profits because you're basically tackling the strategy from both sides. How do you make sure that a strategy is good? Well, you look at the hit rate, right? The win rate of the strategy and the average risk to reward ratio of that strategy. And those together need to be positive, right? And the more positive they are, the more of a cushion you have in order to make sure that you will be positive in the long term, right? Your results will fluctuate whether you like it or not, right? But you want them to fluctuate in a range where, it still works and it works really well. So the best way, because I have the indicators loaded up, and this is essentially the dashboard that's trading these indicators, as you can see. So really the main thing is, obviously we're doing the stochastics, and the point of the indicators is to make sure that we will get signals or we'll get setups without having to look at them, right? So the base time frame to look at this is the 5 minutes. That's a good time frame to look at. And depending on how we set our settings, that's the more trades or signals or setups, suggested setups we get, the higher we go, the more selective it is and the more conservative it is, right? But if you look at tops of these green tops, then you see that the price usually turns afterwards pretty much every single time, because what it is the score of the stochastics, right? The best way to look at this and trade this is, though, whenever we get a signal on the 5 minute, right, we go ahead and look at the 1 minute, and once the 1 minute confirms the signal, that is usually the best time to enter a trade. Same thing here. Here we had a signal, and then once the 1 minute confirmed that trade, then we essentially have, so the indicator, we have multiple confirmations on multiple time frames, and now of that, we put it together in a bundle essentially, and now we have a confirmation over 2 bundles. So what that means is, out of many perspectives, we get the correct confirmations, essentially, right? And you can do that wherever on any coin that you want. Let me go, or Forex, right? USD JPY has been going really well. Same thing here. Whenever we get the signal, we look at the 1 minute and we wait till the signal confirms, which is until now, which is a better entry for that trade, essentially. So yeah, those are important things. And then when is the exit? Well, the exit can be the opposite signal, obviously, but it's the same thing as when we trade normally, right? When do we exit? When the stochastics are topped out, right? So at the 5 minute, for example, we see that the 5 minute topped out here, and the score has been going up, but it's still not all the way up, right? If I look at the 15 minute, for example, then I can see that the 15 minute took a little bit longer to top out, and the 30 minute took much longer to top out, right? And the beauty of this is that the score, the top of that score, is at the exact top of this price. So the 5 minutes topped out way too early, the 15 minutes topped out a little bit too early, the 30 minute topped out too late, but our score in the indicator is at the perfect top, which is beautiful, very nice to look at, right? So it's a good vehicle. It's a nice car, right? You could say it's, close to a Bugatti, right? But that's not the point. The point is that when we trade the strategies, right, we're scalping here, right? These are small moves, even if, Like even if you consider it a considerable move in a trade, it's a 4-hour trade, right? These are smaller moves. What do we need to be aware of? Well, especially in crypto, for example, let me just go to some trade. Crypto, for example, when we have looking at higher time frames, right, it is important to see what trade or what environment we're in, right? So if we're in a bull run right now, then, and you see, say, Bitcoin just going up, and you look at either the indicators on Bitcoin or you look at Bitcoin itself, if we're going up strongly, right, if we have a huge bull run like this, or like just a huge bullish move like this, then obviously longs are going to be preferred over shorts, right? The indicator that we have here is looking up to the 15 minute. And what's interesting is that, up to the 30 minutes actually, again, perfect top at the price top, right? And this is not like, no indicator did that, right? The 5 minute topped out 3 times. The 15 minute topped out too early, way too early, right? So if you would wait for the 15 minutes to top out to take profits, you would be missing half the move. If you would be waiting for a 30 minute to top out, it wouldn't top out actually, and you would be, exiting close to half the move as well. When you look at the indicator to top out, it's at the actual top. So that's something really, really cool, which is something that we didn't even try to do. It just happened as a side effect of, making a score of all the indicators. So learning to do this, like, yes, we have the automated signals, but learning to do this manually will enable you. So I have this, I don't know if I said this to you guys, the people that know me, I have for sure. I have this brick theory, right? Which is, and I, in my eyes, this is how the world moves forward, right? Which is that you have, let's say, a person, a great inventor, right? And for his entire life, he has been doing one thing, his life's work, and then eventually he finishes it, and it's great, right? It's a great piece of work, a great invention, and then a new young guy comes in, and he takes that entire life's work, and he can use that now because it has been invented already. He can use that now 1,000 times over, and by using it 1,000 times over, he makes his own life's work, and then another guy comes in, or girl, whatever, and bundles that together into a brick, and then builds his wall, right? And then another guy comes in, puts that, like, takes that as a brick, and then builds, so it's an exponential growth based on the work that previous generations have done for us, right? For example, pick your poison, steam engine or diesel engine, right? Took, I don't know how long for someone to create it, right? But then, it's very, very simple to do, easy to do, and now everybody has cars that can drive around, and, by driving around the car, they were able to create something else that someone else, eventually an iPhone or something, and then someone can take it and, build their entire business of an iPhone, and then someone can take that business and, and so on and so forth, right? So this is essentially the same principle, whereas we had something simpler, right, which is, it took a lot of work for the same work. Now we have it consolidated, and as we have it consolidated, this amount of work is not needed by our brain anymore because it's here. So now we can focus on the next step and build further, right? And then eventually that next step is going to be consolidated, and then we move further, right? So this is essentially what the principle of the indicator is in the first place. So whereas we spent 50, 60, 70, 100 hours of learning this, now, we can decrease that amount by a lot and use those, tens of hours to do something else. So that is important. But while we do that, it's still just a vehicle, right? And with the vehicle, we need to be able to know how to manage, and we need to be able to know what kind of market are we in order to be able to correctly use the strategy. When we're ranging, it's a very simple strategy. Like whenever we're ranging like this, like for example, we're here time-wise and we know that we're in a range and a signal triggers with the stochastics bottomed out, the chance of the price not going that way is extremely low. So this is a high probability trade, especially with our stop loss, being able to be pretty tight. This is a textbook trade of our strategy, right? And we want to maximize the amount of trades that we have here. How do we do that? We have a two-step verification of our signal, which is, first of all, we get the automated trigger, right, the alert in the Discord, and the second step is that we look into the 1 minute and see if that confirms, because essentially we look at more granular data when we look at the 5-minute time frame, not because of the score is the same, but actually because of the calculations that go on beyond that. So we have two confirmations, but then we also know that we're in a range, and we also know that as we're ranging and overall we're in a very bullish environment. So a long here is a very, very high probability long. We're in a bullish market, we're ranging, and we're at the bottom of a range doing a long. Very high probability trade, right? And that is something very important. It's not just, jumping onto a conclusion, which, usually you would be doing pretty well, but take the other aspects into account as well. How does the strategy work? Are we in a favorable position in that strategy? And what environment are we in? And does that environment favor our trade? And as we do that, the trades that we will be trading are much, much higher probability trades. And because of that, our consistency will thank us for it. And because of that, what will happen is that, when we look at our compounding calculator, we will get towards the path to where we want to, because a consistent compounding is a huge, huge, huge deal. So that's why we want to make sure that we have high probability trades. And that's why we also need to make sure that we risk manage the same way, that we never risk more than 10%. And by the way, risking 10% in a trade it's very aggressive by itself. And we can actually dial it down, because in our situation here, for example, a 3.2 risk to reward, meaning that if we risk 10%, we're gaining 32% here, right? Which is the target of 3 days for us in our daily target. So we can actually risk 3% on this trade to get our 10% daily target. And after that one trade, you're done, right? So this is, you see how simple it is if the risk management is there, if the right trades are there, if you make sure that you check the correct trades, and you make sure that the environment that you trade in is favorable to your conditions. And most people don't do that. Most people don't even know that they have to do it, right? But most people don't do that, and because most people don't do it, they wonder why their strategy doesn't work, even though it should be a good strategy, and so on and so forth. But really what's lacking is the understanding of what they're doing in the first place, right? So that's the other thing. And now, well, how do you make sure that you're able to evaluate a trade the correct way, or evaluate a trade and see that all the environments and all conditions are correct? Well, yes, it might take some experience to do that. I mean, setting up a trade here based on an indicator, especially when it literally is signaled, is not that hard, right? Like most people can do that. Especially when we have the two-step confirmation. So like that's not that big of a deal, but looking at the overall market environment and making sure that we're in a range, might be something that is a little bit of experience is needed, and that's why we have the community where we talk about it, and where we, that's another aspect or another perspective of confirmation, a fourth one, right? Outside of the, are we in a ranging market? What is the environment doing for us, and the signals, right? On top of that, we have the community that can check those boxes and confirm what we're thinking in the first place. And as we do that and we have it confirmed, well, what that means is that we have another confirmation for that trade. And the side effect of that is that the community will then as well grow and get better, and the trade quality in the community is going to get better, where everyone or most people will trade trades that are high probability trades because they're checked from many different perspectives. And that's all we need, because there's plenty of trades in the day in the market, right? And as we can see, risking 10%, you will make probably 3 days worth on one trade. So there's an abundance of profits to be made, which gives us the luxury of making sure that the trades that we enter are high probability trades. And if we do that, and we really are looking for the alignment, and we really confirm the alignment of those trades, then what that means is that our consistency and our account balance will thank us for it, right? So that's something very, very important. And also, the thing that we're trading here is the fact that when there's an alignment on the lower time frames, the price will bounce or get some sort of impulse to the other side. And that is something that happens very often, because essentially it means that the price is away from the average on multiple time frames. So really what we trade here, like here for example, right? On this trade, we enter at the bottom of the range, and we exit at the top of the range when our score tells us so, but also it's the top of the range, right? So textbook trade. That doesn't mean that we're trading the breakout. That doesn't mean that we're trading a bounce and a re-enter. That doesn't mean that we're trading something else. The thing that we have an edge in is the fact that the price will reverse when our score is high enough. That's our bet, right? And that's the only thing that we trade, right? It does not that's the strategy. It does not matter what happens afterwards. We just isolate this simple mechanic in the market, and we profit off of that simple mechanic. If we add in other things, if we overcomplicate it with other things, then we introduce volatility, we introduce chaos, and over a long period of time, it's not going to be sustainable. So we really want to isolate the fact, the edge that we have in the market, the one thing, the isolated situation where we know that with a pretty high probability that's going to happen. And then we're going to look for situations in the market where the conditions are isolated enough where we do that, where the market does that. So we say no to a lot of trades, and we say yes to the trades that are the most likely, where everything works the way it's supposed to be for our strategy, and it's the most likely to do exactly what we expect it to do. And being able to find these trades, and how we find them, we've talked about many times, right? That is the way to our consistency. Like right now, the market's running around, right? It does not matter, right? We made our profit in this one move. That's the thing that we're betting on. What else happens in the market does not matter to us. We look back at this chart whenever we get a high probability trade again, right? That's all we do. And this could be short, by the way, based on the indicators, but really that's all we do, right? So that's the importance of that. we don't want to get distracted by a million other things. We want to focus on the one thing that we're trading, and we want to focus on the one situation where we have an edge in, right? And then what we do is we find different edges, we find different situations, and then we isolate conditions for those, and we can trade those as well, right? But trading one strategy, this is what we're doing. This is the one thing that we're trading, and in order to have more trades, what we do is not force it onto the market. What we do is we look at different markets and different coins and find the conditions that are the most favorable for us. That's how we trade more. We don't trade more by trying to do more trades in one single market. So we have our risk management, we have our trade management, we understand the strategy that we're trading, we have the extra biases of, knowing what market condition we're in, knowing what the current market situation is. Are we ranging, are we not ranging? And knowing obviously the score of the stochastics, and then having the confirmation of the community, and all of those things together, all those check boxes checked will give you good trades, like, I don't know, 39 times out of 40, like very, very high probability, so that's why, there's a bunch of other trades that are, they look good but don't have the check boxes checked, and like, sure, you can trade it, but why not just making sure that the times where we trade are the highest probability times to be in the market? Because when we do, like, there's plenty of trades. Even if you miss a day, even if you miss 2 days and you don't find any trades, usually you make that back pretty quickly. The deficit, like, it's not even a loss, it's a deficit in your target. So that's why it's very, very important to do that. We look at our confirmations by looking at different time frames, and the more you play around with the indicators, the more you will find that. You can also play around with the values of when the signals trigger, and we catch the one move that the strategy is based on, which is literally the move in the range, nothing else, right? Like, if we're at the top of the range and the stochastics are still low, then yeah, we might hold it until the stochastics topped out. But as the stochastics top out, there's absolutely no reason to risk the trade again and trying to, figure out something there where we just didn't have to do that again, right? A trade monkey can do this. Yeah. And that's the point, right? Because if we want something consistent, if we want to have something that we can execute on a consistent basis means that for the next 5 years, I can trade this every single day and basically have the same outcome every single day. Well, in order for that to happen, we need to dumb it down a lot, because any complication, even if it seems simple or seems like, oh yeah, like I can handle that right now. Well, can you handle it for 1 million times in a row? Can you handle it for like at least 1,000 times in a row? No. So that's why we want to really get a routine and really get, get the daily actions that we do in the market into absolute muscle memory, where we don't even have to think about it, where it's really, really easy for us to do. And that is the point. However, what happens with most people, though, is that if that happens, then, and that is like the ego playing, right? Once that happens and we get it into muscle memory and there's no excitement to it, right? It's just boring. What happens is that people try to challenge themselves. And sure, challenge yourself, but don't do it with the money. Don't do it in an environment where if you mess up, you can lose all the money. You can lose years of work within seconds. That's the seriousness of it, right? You literally have the ability to do that. So please don't test yourself here. like just go outside and, I don't know, drive a bike and try to, like, I don't know, do something, you know, but don't do it when trading. It's irresponsible. And I have zero sympathy when someone blows their account because they did something, they tried to challenge themselves, or they did something stupid. Because that's something that I'm telling you on every single call, right? And even then, there's going to be people that will blow their account, you know. So that's something very, very important to make sure and cover, right? So yeah, we want to make sure that we understand the strategy, the risk management of the strategy. We have our extra biases, which is the strategy, the strategy itself, right? Different time frames in that strategy, right? Looking for that confirmation here. And as you can see, the 1 minute triggered a short here, but the 5 minute didn't, and the 5 minute is our main thing that we're looking at, right? So that's important. And then on the 1 minute, we look for a confirmation there, and that's a strategy. But then we also look at what a market environment are we in? Are we, you know, in something that looks like this, where I need to scroll down just to see the bottom of the move, right? So obviously a bullish exponential move. So in that situation, obviously longs are much more preferred than shorts. And on top of that, we're in a range, and we're closing to the bottom of the range. We got a signal, we confirmed that signal in the 1 minute. We're in a bullish market, so this is a textbook trade, goes to the top of the range. This is, you know, this trade should be, or a variation of this trade, we should do 1,000 times in the next year. And if we do it 1,000 times in the next year, good things happen. Right, so that should be the focus, right? We're not trying to challenge ourselves. We're not trying to prove anything. We're not trying to, you know, make $1 million tomorrow. All we're trying to do is stay consistent, and I promise you, everything else will fall into place very quickly, because when we do this, believe it or not, being consistent is actually not that common. That's why 99.9% of traders lose money, because they're not consistent. Because even if they're doing well, they lose money at some point. To drive the point home, I have one person I met in Dubai, actually, a couple weeks or months ago at this point, owner of a prop firm. And you know, I said this before, I'll say it again, the main business model of a prop firm is actually the front end fees of the challenge, right? The challenges. So essentially, just so you know, for every 1,000 people that do a challenge, 20 people pass the first challenge, and 0.8 people pass the second challenge. And out of those 0.8 people, 1/3 makes it to the first payout. And what they do is, even if that person makes it to the first payout, they still usually hedge that person and counter trade that person, because they're probably going to lose. And the chance is that even if they trade with real money, they will counter trade that person. And in that miracle case, when they will actually make money, they will pay it out of the pocket from the money that they got from the challenges. That's literally the business model of most prop firms. And when a person does a prop challenge, on average, they will come back and try the challenge again 7 times. So essentially a subscription model is what it is. And on top of that, they come back 7 times, and the challenges that they do are the numbers or the statistics seem easier than they actually are, right? And the consistency there, like you would pass it with consistency, but people being unaware of the consistency and focusing on the percentage number that they're trying to do is literally what gets them and kicks them out. right? And so that person in Dubai, what he said was that every single person in his prop firm blew their account. The longest that anyone could ever ever survived there was for 2 years. So that was a trader that was doing well for 2 years, and even after those 2 years, he blew his account and lost everything. That is the nature of most traders. And when I say most, I mean almost every single trader, with very, very, very small exceptions. And those very, very small exceptions make all the profit in the market. That's like the number, the difference is large. So when we talk about, first of all, this is why consistency is important. Because if you go to a prop challenge and your main focus is consistency, your own consistency, and not the rules that they put on you, which are designed for you to fail, you will pass the prop firm challenge. We have passed multiple prop firm challenges. Moonwalk can agree. We've passed FTMO, you name it. We've passed multiple challenges with this strategy, with the stochastic strategy. Usually, within 2 or 3 trades, and then we would just trade small trades just to get the rules right and hit all the check boxes for them. But we did that because we looked at high probability trades, nothing else, and our main focus was consistency. So whereas almost all people, right? I think vast majority doesn't even cover how vast the majority is. Almost all people focus on profits in the market and how many dollars they make in a day. Really, what you're trying to get or hit is, did you stay according to plan? Are you consistent with your plan? And as you are, the outcome is predictable. When you're all over the place, the outcome is very unpredictable and, most likely very bad. That's why we focus on consistency. And that's why every single action that we do in the market, that I do in the market, that, we do in the community, is in order to improve consistency. And the indicators are a way, or a leap towards that. So that's important, and having the community aspect of it and getting confirmations from the community in those trades is also very, very important. Looking at the signals and making sure that those trades are okay, and that we are in the correct situations. For example, here, once again, prime example. So here, our longs, obviously they work well. Here we're ranging, so both of them work, right? Both of them work really well. And what I love to see is the fact that the signals usually happen at the close of this candle, right? So right before the big move. And that happens very, very often, right before the big move. So whenever we're ranging, right? But whenever, the price starts to move, quickly somewhere, then we're going away from a range trade, right? Back, and even in a triggered trade where we're in a range trade with the confirmation on the 1 minute, we still have upside in a fully bullish move when we trigger short. So that's really, really good. But then, as you can see, we don't trade anything else until we get a long in a range, because that is the strategy, right? So that's something very important. And Forex is kind of the same idea, except that here we have a more ranging market. Like if Forex, if USD JPY or Euro USD did what Bitcoin did, then I don't know, like there would have to be some war or something, right? So we have the reassurance from there. So we are ranging more, which is easier to trade because we're trading a range strategy, a trend reversal strategy. But even there, making sure that we're not in a strong trend, will help making the right decisions and making sure that we have high probability trades. And we can look at any coins with that. So that's those are actually all the points that I wanted to cover today. The call is a little short right now, but I don't mind that because as you may know, our database got hacked, so I need to redeploy a lot of stuff to get the dashboards back and work on the security and so on and so forth. But if you guys have any questions, let me know. Oh, cool. The lot sizes. Very, very good question, actually. I will cover this as well. If you guys have any other questions, write them down right now and I'll cover them before I hop off. But okay, let's look at the lot sizes. Right, so understanding lot sizes is a lot size, essentially what it is leveraging crypto. It's kind of the same thing, or the amount that you trade with, right? The amount that you trade with. So we have a move. Let's say this move, USD JPY, we got a trade, we got a long, we go to the top of the range, we have a good move, right? We have a great risk to reward, all of that is fine. So if we would trade this with $1, right, or the equivalent of it in whatever currency, if we would trade this with $1, then you would risk 6 cents and you would get back 34 cents. In Forex, the movements between the currencies are small, obviously, because they're tied to countries in the world, right? So what you do here, this move is 0.3%, whereas this move on Bitcoin would be 2, 3, 4%, and this move on Solana would be like 10%, right? So with 10%, trading one of something would make sense, but here it doesn't, right? So if you trade this with $1, then it's not going to make sense. But that's why you have lot sizes, and you have different lot sizes are essentially different amounts of money that you trade with, right? I don't know what the smallest lot size is really, but it goes. You can trade 10,000 of something, say $10,000, $150,000, $100,000, $1 million, whatever, right? So then, assuming the size of a lot size, okay, perfect, thank you. The lot size then is the amount of money that you trade with. The higher the lot size, the bigger the dollar profit, because you're trading that trade with more money, right? I don't know if I overcomplicated it for you, but essentially it's Hans. So one lot is 100,000 units. So if you trade with one lot, then you trade with 100,000 units of something, meaning that if you make 0.34%, you make 0.3% on 100,000. And if you compare that to leverage on crypto, or you can do it there as well, but let's just go to crypto real quick, and I try to explain it there as well. So because that takes one factor out. If we have a trade here, and as you can see right away, the moves are bigger, right? So this move is 5%, 6%, as opposed to 0.6%. And if we trade this with $100, then we're risking $1.35 and we can get back $5.4. However, risking $1, we can definitely allow more risk to happen. So what we can do, for example, is use a 10x leverage. And when we use a 10x leverage, then we're suddenly risking 13% and making back 54%. So we're risking $13 to make back $54 as opposed to $1.3 and $5.4, right? If we do this 100x, then we would be risking $135, which would liquidate us, and we could get back $542 with the initial investment of $100. So that's what leverage is, essentially. So basically, it's a multiplier on how much money you put in, and the way it works technically is that based on the money that you have, the exchange or the broker or whatever you're trading borrows you, a lot, or the money that you choose in the leverage, and as you do that, you trade with more money. Most of it is borrowed from a third party, which is the exchange, and then at the end of the trade, you multiply your profits, you multiply your losses, and at the end of the trade, you bring that money, you return the money that you borrowed, and have larger profits or larger losses, right? So there's that. Hans can explain this as well. Probably overcomplicated it. And yeah, before I let Hans speak, do you guys have any other questions? And yes, with leverage, the US might have some issues. For that, you got Hans and Hubert and Isaac, which are all in the US, which are all, having to figure out that problem. So Hans Hubert, if you connect with him to help him out with where to trade, that'd be great. And yeah, that's it from my side. If you guys don't have any questions, then I'll let Hans explain the leverage situation or the lot situation. Yeah, you see it on the top, okay.
Bye-bye. Can you hear me?
Yep.
I don't know if I'm talking my mic on. But anyways, real quick, if you go back to the USD JPY pair.
One sec. There we go.
And you see the entry, if you hover over the entry, on the right side of the scale, there's like a plus. You see like the plus on your crosshair?
Yep.
Yeah. You can open positions like that. So if you click on that and you do buy one.
There you go.
Yeah, buy one. And then just connect the paper account, paper trading. And just connect it. This is just so people can understand position sizes and risk and whatnot. So double click on minimize the paper trading stuff. So you guys know. Yeah, so if you go back, do the buy one. You buy one. 1K. So if you do 100 unit, 100,000, that's one lot right there. So if you do 100,000 and then buy, it'll be a limit. And then you can, if you hover over the order, it says SL. Move your SL to the desired place.
Oh, nice.
Yeah. There you go. That's how much you're risking.
Right. That's great. That's perfect. That's amazing. Yeah.
On the order side. Yeah. So there you go. $59.
Yeah.
And then you can change your risk accordingly. So, Ritz, he was asking how would he risk 5%. So you're always going to risk based off of your account size. So whatever your account size is, if you click on 100,000, yep, there you go. And then on it says risk right on top of the stop loss. Yeah, move that to 5%. Yep, the whole thing, percent.
Is that 5?
There you go. Your risk is now 5,000, which is 5% of 100K. So if you hit modify, it'll change the whole order to the size that you want it. So now you're risking 5,000, and then your target would have been 28,000, which is insane.
Yeah.
So there you go. Use that to learn about position sizes. It's very helpful.
Okay, cool. Yeah, that's really cool. I never used this. I love this. It's amazing. So yeah, there you go. Thank you, Hans.
No problem,
Right.
man.
All right, cool.
That was
So
all.
I hope that helped, Ritz. And you guys, Hubert and Hans, if you guys can help him out with, leverage. I have no idea how it works with leverage on Forex in the US, but I know that crypto has its own issues. So cool. Thank you for taking care of that. Any other questions? Let me know. Right now, other than that, you can ask me in the Discord, and yeah, that has been all, and I'll see you guys there.